should you transfer your money from CPF OA to SA so that you can earn additional interest? On one hand, by transferring over, you will get to earn additional interest and hit the full retirement sum a lot sooner, so that you can go 好年 on hardware zone. On the other hand, if you don't transfer over, you can use your OA money to pay for your house loan or invest it so that you can earn even more money than just that 4%. So how? So in this video, we'll be discussing everything you need to know about transferring from OA to SA, why you should transfer, why you should not transfer, or is there a better alternative? Then finally, if you do decide to transfer, I will also show you a quick step-by-step guide on how to transfer. Alright, let's start with why you should transfer first. And of course, the answer is by transferring over, instead of just earning 2.5% interest in CPF OA, you will now earn 4% interest in CPF SA. So that's an additional 1.5% interest. Then people be like, "Che, only 1.5% interest? So little?" But don't underestimate this 1.5% interest haul. With the magic of compounding, the additional interest that you can earn is actually quite big. For example, let's say you are 30 years old now and you transfer 100k from OA to SA. After 25 years, when you turn 55, you will have an extra 81k interest as compared to leaving the money in OA. So that's a lot of additional interest, yeah? Also, this whole OA to SA transfer is the main strategy of 1M65, where if you transfer your money from OA to SA at 30 years old, you and your partner's combined balance will hit $1 million by 65 years old. And this is important because by having more money in your CPF, you have a higher payout when you retire. So it will be the difference between eating cai fan every day versus eating Din Tai Fung every day after you retire. So let's transfer all our money to CPF SA. Hold up, there are 3 important things you need to know before you transfer your money to SA. 1. This transfer is irreversible. So once you have transferred from OA to SA, you can no longer transfer the money back to OA. 2. You can only transfer from OA to SA if you are below 55 years old. If you are 55 and above, you can only transfer to RA. 3rd, and this is the most important part, you can only transfer to SA if your SA balance is less than the full retirement sum, which is $198,800 in 2023. This balance also includes whatever SA money that you have used to invest. So once you have hit the full retirement sum, you can no longer transfer over. So with that in mind, let's talk about what you need to consider before transferring over. Quick pause. With Moomoo, you can now check out your favorite company's latest earnings results, revenue breakdown, operating data, and some key financial numbers. There's even a section which shows analysis of the company, like what's the consensus rating, target price, and some detailed ratings by famous analysts. So, because Moomoo is celebrating Singapore's 58th National Day, they have a deal for both new and existing users. They are currently offering a fantastic 5.8% guaranteed yield for a maximum of 80k for 30 days. To get the deal, tap on Me, Promotions, look for the 5.8% guaranteed returns deal. Then tap Claim Rewards to start the deal. As a bonus, if you sign up with my link down below, deposit $100 and perform 1 buy trade, you will earn a $20 cash coupon. And 2, when you deposit $3,000, make 3 buy trades and keep the money in your account for 30 days, you will receive 1 free C Limited stock worth around $80. And 3rd, if you deposit a total of $10,000, perform 5 buy trades and hold for 30 days, you will earn another free Apple stock worth around $240. So if you are interested, you can sign up to Moomoo using my link down below. With that being said, let's get back to the video. First, how much money do you need for your mortgage? As you already know, house prices are going to the moon nowadays, bank loan interests have been going up, and the government has reduced the loan-to-value limit from 85% to 80%. All this means that if you are planning to buy a house now, you might need to use a lot more OA money as compared to previous years. And even if you already own a house, you might still want to keep some emergency funds in your OA. Just in case, touch wood, you lose your job, you'll still be able to pay your house loan on time. Besides that, do you have any plans to upgrade to a bigger house? Like maybe you want to buy a condo like that young couple, or buy a landed property like that Naomi Neo. In that case, you might need to keep some OA money for future upgrades. So this is super straightforward. Don't transfer from OA to SA if you have plans to use your CPF money to buy a new house, upgrade your house, or want to leave some OA money to pay for your mortgage. But what if you don't have any of these housing plans? Should you still transfer your OA money to SA? Here comes the second consideration. Can you get a higher return elsewhere? So, by transferring your money from OA to SA, you'll get a guaranteed 4% interest. Great! But if you know how to invest, you will know that 4% is not hard to beat. Historically speaking, of course. For example, Endowus Lion Global Infinity US S&P 500 Stock Index Fund gave 11.45% 10 years annualized return. Or their Lion Global Infinity Global Stock Index Fund gave 8.76% 10 years annualized return. So that's easily double of what you can get from CPF SA. But of course, this is just cherry picking the best funds. If we check FSM1's fund list, most of the funds were unable to deliver more than 4% return over the long term. In fact, CPF found that almost 1/3 of people who invested their CPF money actually made less than 2.5% or even lost money. Wah, sibei jialat ah. Might as well don't invest. So it really depends on how confident are you with getting a higher return than 4%. If you are confident, great, you can just invest that money. Otherwise, you can just transfer and get a steady or maybe 4% return from SA. Also, it's not just for stock investment. You can also use the OA money to invest into Singapore properties and potentially get a higher return too. Property prices for HDB resale and private homes have been going up fast and furious over the past few years. And while the price increase may slow down this year, chances are, with limited land and increasing demand, property prices may still continue going up in the future. Not guaranteed, of course. Third consideration, tax reduction. So there are actually two ways you can increase your CPF SA balance. You can either transfer from OA to SA, or you can directly top up cash into CPF SA. There's actually a third method where you can top up to CPF MA. Then when your MA is maxed out, the money flows into SA. But I won't talk about that here because the effect is very similar to topping up to your CPF SA. So when you transfer from OA to SA, you are not using any cash to increase your CPF SA balance. That's good. But if you directly top up cash into CPF SA, you will increase your CPF balance and get a tax relief at the same time. This is super important because when you just started work, you'll be earning around 3K to 4K unless you are an underpaid art student. Then that one's different story. But for most cases, you will be in a 7% tax bracket. This means that if you do a cash top up to CPF SA, you will save 7% on your taxes. So that's nice. But over time, the longer you work, the more experience you gain and the higher your pay will get. Unless you're one of those people from hardware zone. In that case, your pay will forever stay the same one. Otherwise, it's very likely that 10-20 years down the road, your pay will be a lot higher compared to today. And if you're lucky, you will end up in a much higher tax bracket, like 15% tax bracket or even more. When that happens, if you top up to CPF SA, you will get a 15% savings on your taxes. Or in other words, it will be as though you made a 15% return. But here's the thing, if you had maxed out your CPF SA very early on, you will no longer be able to top up the CPF SA anymore, and hence would be unable to save on your taxes through CPF top-ups. So you have to decide, do you want to quickly transfer from OA to SA now and earn additional 1.5% interest, or do you prefer to wait till you get a much higher pay before doing a cash top-up to SA? In which case, you could easily save a lot more tax. So it totally depends on your preference. But here are my suggestions. First, keep your options open. Don't rush to transfer everything from your OA to SA. You may not have plans to upgrade to a house or buy a new house now, but anything can change in the future. Yes, that 81K missed interest may sound like a lot, but that's because it's over 25 years and it's transferring a huge amount over, which not many people will have, especially if they are using their CPF money to buy a house. So you are not missing too much interest here. And while it feels good to hit FRS early in your life and 好脸 to everyone else that you did it, you also need to remember that your money in CPF is only meant to secure your retirement and nothing more. Because while CPF gives you a lifelong payout, this payout is fixed and it doesn't go up together with inflation. So it doesn't matter whether you hit FRS in your 30s or in your 50s. As long as you hit it before 55, you'll be fine. In the meantime, there are many ways to get a higher return on your OA money. For example, investing in Singapore T-bills, which is giving around 3.75% interest. So that's not too far off from SA 4% interest. Or you can lump sum pay off your bank loan. This will make sense, especially if your mortgage interest is above 4%. So it will be as though you made a 4% return on your money. Otherwise, if you are willing to take the risk, you could invest in a broad-based market fund like Endowus Amundi Prime USA Fund or the Amundi Index MSCI World Fund, both of which could also be a good bet to get a higher return over the long term. Second, aim to hit a 60k combined balance in your CPF OA and SA, because your first 60k CPF balance will earn additional 1% interest. Though for CPF OA, it's capped at 20k. Take for example, if your CPF OA has more than 20k, you will only earn an extra 1% on your first 20k in OA, while the rest isn't earning any bonus interest. So what you can do is transfer some of that money into SA, so that you can earn an additional 1% interest from SA. But of course, make sure you leave some OA money for your mortgage loan. Finally, if you want to transfer your OA money to SA, here's a quick step-by-step guide on how to do so. First, head over to CPF website, click on Login and do your usual SingPass login. Once you are in, head over to Tools and Services, then under Forms and E-Applications, click View Forms. Expand Save More with CPF, then under Cash Top-ups and CPF Transfers for Retirement, click Apply Online. Tick on the disclaimer that you are too lazy to read, then click Start. Tick CPF Transfer, click Next. You are able to transfer your CPF OA money to yourself or your loved one. But let's choose myself here. Then enter the amount that you want to transfer over. Click Next. Here, you can choose anything. Or you can always tell them that I referred you guys. Then click Next. Check everything is correct. Then tick to agree. Then confirm. And ta-da! You have successfully transferred your CPF OA money to SA. This transfer will be reflected within 1 working day. So that's all for this video. Hopefully you found it useful. But if you have any questions, you can always join my fast-growing Telegram group to ask any questions that you may have. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.